Chapter 9, we cover the monetary tools that the Fed uses in more detail. So we talked about the Fed and the European banks in the last chapter. Now we kind of get into a lot of the different details of the different types of policies that they use. Because obviously tools are good things. It talks about that. You know, that's what we use to get things done. So we got to make sure we're using the right tools, though, because obviously the wrong tools are not going to get the job done correctly. So they talk about open market operations, and in a lot of the different things they abbreviate that OMO. So always kind of come back and think, okay, open market operations are the OMOs. And basically what those are is buying and selling government securities to influence the level of bank reserves. So they're not buying the bonds directly from the government. It's not like the you know what I mean, they're becoming a creditor to the US government. They're actually going out into the secondary market. So like people like you and I could have those bonds, and they're buying those. So you know, and it gives you a good example if you read through that book. You know, because it's real basic, like, you know, these people are in a room and they offer so-and-so the money. But so say if that person has those bonds and they need the cash, it's going to create cash into our market. So they're gonna buy this, you know, $10,000 worth of bonds from this person. That person's going to take the $10,000 that was held in bonds and now deposit it into their bank account. So then imagine if they did that for 1 million people. Then all of a sudden there's $10 million that's in our bank accounts that used to just be held by the U.S. government. You know what I mean, in the Treasury. So it creates money that way. So that open market will increase the bank reserves, which then will increase the money supply. And then the banks can loan that money out, which then will increase it more. So that's what they're hoping would happen through that open market operation, if they're trying to expand it. So that's an expansionary open market operation. Then there can be the flip side of that. There can be a contractionary open market operation. So then in that case, they're trying to go the other direction. So then they will go out and they will sell those bonds that they were holding back out into the market. So then now people are taking their cash out of the market, buying the bonds, and then the cash is being taken out of the banks and the banks are not able to borrow that money. So again, it all still happens in the secondary market with the Fed buying bonds from people or selling bonds back to people if they want to kind of control that money supply. Then they give some different types of definitions. So they've got dynamic transactions. So those are open market operations designed to change the level of the reserves that the banks are holding. Then there's defensive transactions, and those are open market operations designed to maintain the level of the reserves. So not either increase it or decrease it, but just maintain it where it's at. So those are defensive. A repurchase agreement is when they sell a security with the agreement to buy it back after a specified period of time. And then a matched sale purchase is when the Federal Reserve sells government securities to a primary dealer or a bank in another country with the agreement to buy it back. So again, it's kind of like moving the money for a time period, and then which may increase the money supply, and then reverse it after a specified period of time. Okay, then we have some different monetary policy tools, a discount window and the term auction facility. So we've got primary credit is when a good bank, a healthy, strong bank that's not in financial trouble, goes out to borrow the money from the Federal Reserve for a short period of time. The secondary market is when the banks that are not financially healthy, but they're struggling, they can borrow from the Federal Reserve also, but then they have to pay a penalty due to their kind of poor credit. And then there's what they call a seasonal crunch, where they're going to give high swings in their level of reserves during these different seasons. And then the stigma effect is when banks don't want to be known for having, like, say, that secondary credit. They don't they feel like if they borrow from the central banks that they're going to kind of get, it's going to be a sign of financial weakness. And then you have to figure these banks are publicly traded companies. If that was something that was released, it could impact their stock price. So again, maybe they choose not to do that for that reason alone. And then a credit crunch is when when the availability of the credit in the financial markets is being reduced, and so then more people want it than it's out there, and then it's normally some sort of like an irrational type of a reaction when that credit crunch happens, and it's because the banks are scared to take the risk. So the banks are the ones that are being irrational. They're like, they don't want to extend any credit. They have much higher standards. Well, then it puts the whole economy in a slump if that's the case. Then the term auction facility, so that they abbreviate a TAF. So a term auction facility is when the Fed is going to auction off funds, and they send out a notice to all the interested parties or the interested banks about how much they're going to auction and what the rate is. And then people can bid anonymously. So then that kind of does away with that stigma effect, because it's going to be an anonymous bidding. So they're not going to know which banks it is, and it's in certain increments. So the benefits of it is the control standpoint. The Fed knows, and they announce, okay, we're going to lend $100 million out, or whatever it is. So they have that amount out there. Because it's anonymous bidding, the stigma effect is not a part of the transaction. I mean, no one's going to hold off because of that. And then there's a maximum amount. No bank can get more than 10% of the total auction. So it's going to spread the money a little bit fairer and maybe a little bit more across the whole economy. Okay, then there's more tools. Emergency lending. And emergency lending is basically when the economy is getting into a state where it's not just the banks that are in trouble. So if it's just the banks that are in trouble, again, the Fed has those different ways of dealing with those. When it goes beyond the banks, so it goes into your investment bankers, your insurance companies, non-bank financial institutions, where we have so many different ways that we can invest online and things like that. Those are not banks. So when those people start to run into trouble, then what do? Because they don't have that lender of last resort. They can't go to the Fed and say, hey, I'm in trouble, I need money. They have to get bank loans. So they came up with this way to deal with that. So the Fed can lend up to $2 billion of Treasury securities for a term of 28 days to these types of people for a fee. So then that can kind of flood money into those security dealers and enable them to kind of get back on track. But again, it's short term, so they have to be able to kind of reestablish and get their money back. And then there's a primary dealer credit facility where the Fed loans money overnight to the security dealers who pledge collateral. And again, normally those collateral are investment grade securities, so kind of stocks and bonds. Then there's a whole variety of ones. So there's an asset-backed commercial paper, money market. There's a money market investor funding facility, commercial paper funding facility, asset-backed security loan facilities. So if you look at the dates of these, if you read through this in the textbook, it was like each month. So during 2008, when we had like the Depression, or kind of whatever they had, we had a very deep recession, if it wasn't an actual depression. But so each month the Fed was trying to come up with a new way to step in and bring those markets back. So each one of those, it was a different way of them to do it. So you can kind of read through those just to see how they did it. Then there's quantitative easing. So then that is when they kind of rescued the mortgage industry. So they purchased $100 billion of debt from Fannie Mae, Freddie Mac, Federal Home Loan Banks, and $500 billion of mortgage-backed securities. So again, that was during our real estate crisis, where people were walking away from the mortgages. The real estate values are dropping. mortgage rates were super low, but nobody could get credit because, again, you're back to that credit crunch where everybody's scared. So it was a whole fiasco. So that was their way of doing that. So they kind of rescued out those mortgage companies and then enabled them to start issuing loans. You know what I mean? You still keep to good credit standards, but issue loans to the people who are able to pay them and kind of get back onto that norm, which we eventually did. And again, those mortgage-backed securities, I think I talked about this in the other chapter, but what those were is a way for investors to invest money in mortgages. So you would have like a share of this mortgage-backed security. There's really nothing there, though, other than money that this company is now loaning out in the form of mortgages. But that's what kind of created this whole fiasco in the first place. When there's too much money, too many investors are interested in making money that way. They're just looking for people to loan it out to. Well, then you lower your standards. You're letting anybody get a mortgage. You let them borrow at 110% of the value. So those are the things that brought it in the first place. But those are the people that need to be rescued, because at this point, the share prices of those are dropping. People are selling, money's backing out. People are not paying their mortgages, so money's not coming back in. It was pretty much a huge fiasco. So the Fed stepped in and saved them through that quantitative easing. And again, there was these different rounds. So there was round 1, round 2, round 3. You can read through those, but they all kind of go back to different dates. Then there's the required reserve ratio, which that talks about how much money the banks are required to keep in their reserve, so they can't loan it out. And they say this ideally should be the best way that the Fed can control the market, is by saying, hey, this is how much you need to keep, this is how much you're allowed to loan out. But if you read through this in the textbook, it says there's a couple things that have impacted that due to our online banking abilities. So one is the fact that they can sweep. And I know, like when I worked in business, we always swept our checking account. So we would say, okay, at the end of the day, let our checking account go down to, let's say, $20,000 and sweep everything over into the money market. Because then the money market earns interest, higher interest, not a ton, but more than the checking accounts did, especially for businesses. Then you might sweep it back. Excuse me. Some of them are automatic, where they automatically sweep it back. The business I worked for, we wouldn't necessarily sweep it all back. We might leave it because a lot of our bills were paid on a Friday, and we might leave it for more than just one night. But so then those monies are leaving and then coming back, so that impacts it. And then with ATMs, banks have found that they need to have more money on hand because people are going in and using those ATMs and taking the cash. And really, the last thing you'd want to do is to go to an ATM and not get your cash out. I mean, people would definitely lose faith in our banking system. So then it said 70% of banks leave more than the required reserves in their banks and in their treasury because of those reasons. So then that really doesn't impact them. Then we get into money demand. And we have two different theories. So we have this Irvin Fisher. He's back from like 1911. So I mean, a long time ago. And there's like a mathematical equation that he comes up with. But basically, it's like saying that our money supply and how often the money is moving, like they call that the turnover rate or the velocity, how quick it's moving in a year, should equal our gross domestic product, how much we're purchasing. So then if the money supply goes up, the gross national, because it's an equation, it needs to equal. If the money supply goes down, the gross domestic product goes down. But then the problem with that is the velocity. I mean, is the velocity constant throughout the year? Is it constant from one year to the next? So then another guy, John Maynard Keyes, said that the money supply is not constant. There's a lot of things that impact that. So he said there's three motives that people have for holding money. So one is the transactional demand for money. So we do need to buy stuff. We need to buy products, goods, services, food, things like that. Then there's the precautionary demand for money. So that is that if we're getting into uncertain times or times that we feel like we need to have a savings account or we're saving for a specific purpose, then we're not going to spend the money and we're going to stay and we're not going to invest it in anything else. We're going to keep it in our checking or our savings account. Then there's the speculative demand for money. So they give the example of, say, if you think interest rates are going to go up in 6 months, you've got money in a savings account and you want to put it in the bond market, but you suspect bonds are going to pay more later. You don't want to lock into a bond today when you could lock into a bond tomorrow and get a higher rate of interest. And then they also give you a whole list of other factors that can change that demand for money and then how that impacts the monetary policy. So you can kind of look over some of those. And then, again, ideally, we hope that controlling interest rates can impact the money supply, but those are still within people's power to change those. So, I mean, again, we can still go back to those same reasons to say, I'm saving for something specific or I want a higher rate. But ideally, if interest rates go up, it encourages saving and discourages spending. If interest rates go down, it encourages borrowing the money because you're getting a low rate of interest and spending that money. Then they get into some problems with the tools. So we have a liquidity trap where the expansionary monetary policy fails to stimulate the overall economy, and there's a high level of savings and a lack of borrowing. So then in that case, again, maybe we're nervous. We don't quite want to go get a mortgage or go get a new car loan, and we're going to hang on to those savings just as consumers. The government budgets, their deficit also can impact the monetary policy. So if the government deficit ends up pushing market rates up, and at the same time, if the Federal Reserve is trying to lower the interest rates to encourage spending, then we can have some opposite effects of that. Oops, sorry. The monetization of the public debt is when the governments require commercial banks to purchase government bonds. So that would be, again, if they're going into that deficit, they need to issue bonds, and they want to be able to issue them out to the banks. And then there's the zero lower bound where it's saying that our interest rates could actually go down to zero. So again, it talks about during that time of the recession, it was getting to that point. Well, then, you can't borrow money for free. I mean, that defeats the whole banking industry. So that is a problem that they need to, deal with to stop that from happening, because that makes it very difficult for that central bank to expand the economy that way. Then the last section deals with the Eastern Central Bank. So again, with everything we talked about so far was just our Fed in the U.S. government. So then the European Central Bank, they have some OMOs, or open market operations, as well. So they have tenders. So what a tender is that for a fixed rate tender, the European Central Bank will specify the rate at which it will lend funds in advance. And then the participating financial institutions can then bid on the amount of money that they want if at that published rate. So again, it's a way to get the money in the hands of a variety of banks in the European area. So then the types of open market operations that they have main refinancing operations, where they are repurchase agreements and collateralized loans. So again, the repurchase agreement is when they agree to buy it back. So they're going to give them the money now so that they can have it for like 28 days or 30 days, and then they agree to pay it back at that point in time. The collateralized loans is when it's like a security or a government bond or something that's backing that loan. And again, those are normally for a specified period of time as well. Then there's longer term refinancing operations, and those are designed to increase the level of the bank liquidity while increasing the demand for government bonds. which would then push the yield of the debt for the government down. And then there's fine-tuning operations, which are quick tenders that are conducted by the national central banks on an ad hoc basis. So the ad hoc means as needed, to manage the liquidity and the interest rates as they see something changing. And then there can be structural operations that would be designed to influence the liquidity level of the euro institutions. They do have some standing facilities that they've got marginal lending facility where the European Central Bank monetary policy that provides overnight loans to their member banks. And then the deposit facility is where they pay interest on the deposits that those banks keep with the European Central Bank. And then they too can have the quantitative easing. So that targets longer term refinancing options, which are designed to encourage the banks to lower their borrowing rates to spur the economy, to businesses and consumers. And then they also set minimum reserve requirements. So their institutions have to hold 2% of the returns against their short-term deposits. But again, they'll do the same thing. If they're trying to contract the economy to bring it down, it's going to increase that minimum reserve requirement. If they're trying to expand the economy and get money back out there, they'll reduce it. So they would do the same thing basically that we're doing. So those are the different types of tools in a lot more detail. So there's a lot of different terminology in there and a lot of different definitions of stuff that you need to know.